This is a continuation of chapter 14 on mortgage closing cost. This is after we have settled on a price that we're going to pay for a property. Then we'll go into finding out what our closing costs might be. You're going to receive not actually a title unless you pay full cash for the piece of property, and you do not receive the title or the deed at the closing. It will be after all the paperwork has gone to the appraisal district and the title information has been changed, and then you will receive it. If you have a mortgage, then you're going to receive what they call a warranty deed, and that will be your deed until you have paid off the mortgage. And then once you've paid it off, you have to go and show that and tell them that you have paid it off, and then you will be receiving the official title or deed. Whenever you buy a piece of property, not only do you have the cost of the property, but you have the cost of buying that property. And some of these expenses will be the loan origination fee, credit reports, appraisal fees, title search, title insurance, inspections, attorney fees, recording fees, and broker's commission. When you get ready to, everything has been agreed upon, then there will be a meeting that will go over all the closing costs in what they call a statement or closing statement. Your real estate agent, the seller's real estate agent, if they have one, and if you have one, the title company people, and it can also be, then the buyer and seller will be there. And they will go over line by line, going over all of these closing costs, both for the buyer and the seller. And prior to this meeting, you will receive a call telling you how much money that you need to bring to the table. So you'll have to bring a cashier's check and a certain amount of money. And also, there may be a few additional costs that you may want to have a checkbook so that you can write those expenses. It's a document that provides a detailed accounting of payments, credits, and closings of a real estate transaction. The next slide is going to show you a worksheet, and this is a handy document to have when you're comparing lenders, and you do want to compare what you can get through different lenders and then make your decision on which lender that you want to go with. This is also in the textbook. Some of the things that you'll be looking at is how much will the title and title insurance cost you, and what about the hazardous insurance and interest tax, and any kind of flood determination, PMI, private mortgage insurance, or that is the insurance that you have to pay if you haven't put down 20%. So the appraisal fees, so there's all the fees that could possibly be involved in buying a piece of property is listed on this worksheet. So you can see that it's quite extensive. We're going to move to a problem that will give us a chance to look at how to figure our closing cost. My computer's, I don't know why it's moving slowly through this PowerPoint, but this is our problem that we have. Kathy that's purchasing a townhouse for $120,000. The down payment is 20%, and the balance will be financed with a 15-year fixed rate mortgage at 9%. There's going to be 3 discount points, and each point is 1% of the amount financed. Kathy has put down a deposit of $10,000. This is what they do. They do an earnest money contract, and you put X amount of money down that you are going to buy this piece of property. And this will be credited to her down payment at the time of the closing. In addition, she must pay the following expenses: loan application fee $100, condominium transfer fee $190, title insurance premium 3/4% of the amount financed, the hazardous insurance premium is $429, prepaid taxes $310, and attorney's fees $500. So they want you to calculate the amount due from Kathy at closing, and if the seller is responsible for the broker's commission, which is 5.5% of the purchase price, $670 at other closing costs, and the existing mortgage balance of $65,000. So they're wanting to know what Kathy's going to have to pay and what is the proceeds that the seller is going to receive. So we're going to look at Kathy's part first. We determined that her down payment, if it's 20% of the buying price, is $120,000, so it's $24,000. So the amount financed is the full price, $120,000 minus the $24,000 is $96,000. Now to the buyer, there's discount points, and there were 3. Each one of them was worth 1% of the price financed. So we're going to do 96,000 times 3%, that's 2,088. She's making a down payment that we figured up here of $24,000, but she's already put down $10,000 through an earnest money contract, so she's going to need to pay additional $14,000. She has an application fee of $100 and condominium transfer fee of $190. Title insurance is 3/4% of the amount financed, $96,000, so it's $720. Her hazardous insurance is $429. Prepaid tax is $310. What they usually do on a piece of property, they will prorate what the seller needs to pay in the property taxes up to the point that they owned it, and then the property taxes that need to be paid from the buyer from that point on. And the attorney's fees are $500. So if you just go to an attorney and you don't go through a title agency, then you may have this fee. So on the Kathy's part, she's going to owe $19,129. Now the amount of money the seller's going to receive, the purchase price was $120,000. If they have to pay the broker's fees or the real estate agent fees, it's 5.5 times the selling price, $6,600. And then they have closing costs of $670. But they have to pay off the mortgage. And what happens is that the attorney or the title company collects the money from the seller, and they will send the $65,000 to the mortgage company to pay it off, and then they will give a check of $47,730 to the seller. The next thing we're going to look at is the adjustable mortgage. This is where some people have gotten into trouble in the past when we've had so many people that lost homes. Not only the economy turned down, but they had gotten into these adjustable mortgages, and then they tripled and doubled their payments when they made this adjustment to their mortgages. So the adjustment period is the amount of time between one rate change and the next on an adjustable rate mortgage, generally 1, 2, or 3 years. The index rate, the economic index to which the interest rate on an adjustable rate mortgage is tied. A margin or spread, and this is the lender's margins, what is called, or the spread. This is a percentage points added to an index rate, so this is our index rate, to get the interest rate of an adjustable rate mortgage. Calculated or initial interest rate, that is the interest rate of an adjustable rate mortgage to which all future adjustments and caps apply. We also have what they call the teaser rate. This is a discounted interest rate for the first adjustment period of an adjustable rate mortgage, the ARM, that is below the current market rate of interest. And it is appropriately named because this gets people into a mortgage that they really cannot afford because they don't understand these adjustable rate mortgages. So be very careful with these types of mortgages. Interest rate cap, it's a limit on the amount of interest rate that an interest rate can increase on an adjustable rate mortgage. A periodic cap is a limit on the amount the interest rate of an ARM can increase per adjustment period. And then we have overall cap. This is limit on the amount the interest rate of an ARM can increase over the life of the loan. So let's see how we calculate these different rates. Calculated interest rate is the index rate plus the lender's margin. The maximum rate per adjustment period is the previous rate plus the periodic cap. And the maximum overall rate of an ARM is the initial rate plus the overall cap. So let's use these to see how it works. We have Derek that has an adjustable rate mortgage, and the margin on the loan is 3.4%. You can think of this as lender's margin. And the rate cap is 7% over the life of the loan. The current index rate is 3.2%. So what is the initial interest rate of the ARM, and what is the maximum overall rate of the loan? So to calculate the initial ARM rate, you take the index rate, which is 3.2, and we add the lender's margin, which is 3.4, to get 6.6%. And then the maximum overall rate is the initial rate, which is a 6.6 we just found, plus the overall cap that was given, 7%, so it's 13.6%. That's the highest rate that they can charge. Now we're going to move to another section, and this is on second mortgages and home equity loans and lines of credit. A lot of people took these second mortgages when interest rates fell so low that they could take a second mortgage on their home and they could build onto their homes, and it was a very, very low interest rate. You have to be very careful because a home, a real estate property, is you don't want to leverage yourself so that you're in jeopardy of losing a home. Once you have paid it off and then you do a second mortgage, you have to be very careful that you can pay off that second mortgage so that you won't have to lose your home. So a home equity loan is a lump sum second mortgage loan based on the available equity in a home. So if you have totally paid your home off, then whatever it's appraised at is what is how much money that you can receive as a home equity loan, or a certain percentage of that. Home equity line of credit is revolving credit second mortgage loan that made on the available equity in a home. That's like a credit card wherever you can go to it and dip into it as often as you want. Credit limit is a pre-approved limit on the amount of a home equity line of credit. Just like you do on credit cards, they have a limit as to how much you can borrow. This 1413 exhibit shows you the amount of from 2006 to 2010, and you can see how it steadily went up, and with 2010 being so high, the number of foreclosures and repossessions. We're going to calculate the potential amount of credit available to a borrower. And the first step is to calculate the percentage of the appraised value, and then the appraised value times the lender's percentage gives the percentage of appraised value. The second step is to find the potential amount of credit available, and we take the percentage of appraised value, which was step 1, and subtract the first mortgage balance, if there is a mortgage balance. We have Robert's home is appraised for $92,900. The balance on the first mortgage is $32,440. If his bank will loan up to 80% of the appraised value, what is the potential amount of credit available to him on a home equity line of credit? So we take the appraised value, which is $92,900, times the 80% of the appraised value. So $74,320 is how much line of credit that that person can have, or the percentage of appraised value, I'm sorry. Then we go down and we find out how much is a potential credit. We take that appraised percentage value minus how much is already on, still owed on the property, so they can have $41,880. Looking at qualifying ratios, how do lenders determine, if you are a good risk for loaning money to? The qualifying ratio is a ratio used by lenders to determine whether borrowers have the economic ability to repay loans. Housing expense ratio. This is a ratio of a borrower's monthly housing expense, which includes principal, interest, the tax, and the insurance, to monthly gross income. Not net, but your gross income. And your total obligations ratio is a ratio of a borrower's total monthly financial obligations to the monthly gross income. And to calculate these, the housing expense ratio, you take your monthly housing expense, which is the principal, interest, tax, and insurance, and divide it by your monthly gross income. Total obligation ratio is the total monthly financial obligations. This is your housing expense. This can also be all your expenses that you have divided by your monthly gross income. And then the lenders use these percentages here for a FHA loan. If your housing expense ratio is 29% or less and your total obligation is 41% or less, then you're a good risk. And on the conventional, it's 28% and 36%. So we're going to use these ratios. We have a gross income of $3,100 per month, and she has applied for a mortgage with a monthly PITI of $669. She has other financial obligations totaling $375 per month. What is her housing expense ratio and her obligation ratio, and what type of mortgage would she qualify for? So we're going to take our monthly housing expense, our PITI, the $669, divided by her monthly gross income, so that's 21.6%, her ratio. Her total obligation is adding these two together, dividing it by the gross, is 33.7%. And then we compare these amount to the lender's ratio. And on the previous one, FHA was 29% and 41%, and so these two fall into that range. And also conventional was 28 and 36, so they're below that amount, so she could apply for either the FHA or the conventional mortgage loan. And what is the monthly principal interest and total interest on a $235,500 mortgage at 6%? You'll go back to page 459 to use that. But the first thing you need to do is find the number of 1,000s financed. So we divide 1,000 and 235.5, and we get 235.5 1,000s. And then we would go to our table, we'd look up 6%, 30 years, and our factor is 6.00. So then we would take our numbers of thousands times our 6 point, and we would come up with a 1,413 would be the monthly payment, and the interest on that amount, total interest, is 1,413, and we have times 360 days minus the 235,500, and so we come up with 508,680. And we subtract, that's the total amount that would be paid on it, minus the interest of 235,500. So total interest is $273,180. So this is the total number of payments that would be made minus the interest, and this would be the total interest. Sorry, this is multiplying, the total interest is this amount, and then minus the $235,500 is $273,180. Okay, and that ends chapter 14.